Good morning. It's Monday, the 29th of July, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, but now in transit. A fresh reminder, I'm still traveling and thus will be intermittent or have shorter episodes for the next 3 days. And the take for today, the gold Mirage. Gold prices and net asset values of gold exchange-traded funds fell sharply last week after the government reduced basic customs duties on gold and silver from 15 to 6%, which is the sharpest reduction on record and the lowest since June 2013, says the World Gold Council. Now, I saw an interesting headline that was doing the round suggesting investors had lost some 10 lakh crore rupees or some huge amount of their wealth when prices fell because of the drop in customs duties. It was bizarre at so many levels that I did feel the need to address it, which also triggered an opportunity to make a larger point or a more important point, which I'll come to. First, gold prices. 22 karat gold is currently quoting at about 63,000 per 10 grams. A year ago, it was about 60,000 rupees per 10 grams. Now, if you look at international prices, gold futures were around $2,000 in January per ounce and about $2,430 last night. So, globally, prices have risen steadily, and we've talked about this consistently on the core report. The reduction of import duty does hit the domestic price, but not so much compared to a year ago, which means the final impact. And gold was never an artificial intelligence stock that could keep rising or shooting up. If you thought so, then well. Also, gold investments via mutual funds or ETFs are the hedging part of your portfolio and not the aggressive, risk-based part of it. But the reason is important before I come to the flawed conclusions. Gold prices have risen largely because central banks from India, China, and Turkey, amongst many other countries, have been buying steadily. And why is that? That's because gold is an important reserve to hold on to in unpredictable times, particularly geopolitical uncertainty of the like that we've been seeing in recent months. Moreover, several central banks are switching out of US dollars into gold for similar reasons. Back in India, while many people are investing in gold, including via exchange-traded funds, most gold is bought as long-term family holdings, including during festivals and occasions like weddings. And more importantly, I'm yet to meet anyone who measures the daily price of the worth of the gold hanging around their necks or adorning their fingers. Now, back to prices. The question to ponder is, why are gold import duties still so high rather than spending too much rejoicing on the lowering recently? So what happens when duties are high? Well, smuggling picks up, and that's something that we've seen for decades and decades. An Economic Times report says gold smuggling in India was around 100 tons in 2022 and increased to 155 tons in 2023. This is smuggling, which means 155 tons of gold, if this estimate is anywhere near accurate, believe me, it could be even higher than that, is being brought in through ways and means that we cannot see. Now, it's unwise to ignore this, and policymakers, at least some, over the years again, have understood this, that lower duties like lower taxes will increase revenue and deter smuggling or evasion, rather than higher taxes, which will only increase it. But memories are short. So what should gold duties be or import duties be? Well, the World Gold Council chart is illustrative. Import duties on gold were 2% in January 2012 or 12 years ago. I repeat, 2%. And then they kept rising across governments till they hit a peak of 15% in July 2022. To me, import duties on gold prices are also an indicator on how policymakers, including the mandarins at the Ministry of Finance, are thinking over the years. The higher the duties, the more limited the vision and the fallback to the restrictive policies of yesteryears. You will find then that this applies across the spectrum of trade, much to the disadvantage of the local economy, which will do better from lower tariffs. The good news is that we've reversed course again and seemingly learned the lesson that erecting high tariff barriers or walls don't work. And that brings me to the top reports. Can stock markets hold the bounce back? The artificial intelligence euphoria, how long will it last? The cement industry sees more consolidation, but capacity stays way ahead of production. And an economy plus tax forward overview from the Union Budget's proposals.
This is the Core Report with Govindraj Ethiraj.
The markets up and not away. So it was a good Friday ending to the week last week for the markets, with of course no sense of specific direction yet beyond earnings and global cues, which we will come to. The domestic cues are actually negative, particularly if you look at the higher capital gains tax regime now in force for both equities and derivatives, which is all right for long-term investors, I think, but not so good for sentiment-powered shorter-term investors, of which there are substantial numbers nowadays. On Friday, the Sensex and Nifty saw big jumps, with the BSE Sensex rising about 1,292 points to end at 81,332, and the NSE's Nifty 50 going up 428 points to 24,834. According to the business standard, some 27 out of 30 stocks on the Sensex saw gains, with Bharti Airtel, Adani Ports, Sun Pharma, Tata Steel, and Infosys all rising more than 3%. The mid-cap index also outperformed the benchmark indices when it was up about 2%. The small cap was also up about 1%. Now, this was the best session for the BSE and NSE in about 7 weeks, one which also saw the Nifty hit a record high. And both the Nifty and Sensex had logged losses for the previous 5 sessions, thanks to weaker than expected results from several companies, including Reliance Industries, according to Reuters. And then, of course, the capital gains regime, which will hang over the markets for a while. Elsewhere, better news: Brent crude oil is now quoting a little above $81 a barrel, which is quite sharply down from the previous week and weeks where we had seen prices of $86 and $87. Prices have struggled recently amidst selling pressure from trend following commodity trading advisors and a wider retreat in equity markets earlier this week, said Bloomberg. How long can the AI euphoria last? Now, earnings season is underway on Wall Street too. The latest earnings reports are fanning two worries, says Bloomberg, that were already gnawing away at the stock market. One, that the euphoria about artificial intelligence had run too far. And the second, which I think is more worrying, at some point consumer spending will start to stall. While profits overall are still growing at a solid pace and banks' earnings have continued to rise, those concerns, that's the concerns about artificial intelligence and consumer spending slowing down, have derailed a stock market rally that until this month was pushing major indices to fresh record highs, says Bloomberg. Last week was clearly a jolt. The tech-led stock rally that has pushed markets for the past year and a half, again on the promise of AI, sputtered on Wednesday. The Nasdaq 100 suffered its worst day since October 2022, says Bloomberg, adding that the S&P 500 was also down about 2.3% to end a 17-month streak without a drop of 2% or more. Stocks, however, rose on Friday, but more importantly, the turbulence has crystallized anxiety that the latest bull run, fueled by Nvidia and some other tech stocks, could be running out of steam. And that's something that we've been pointing out here as well. Also, interestingly, earnings this week demonstrated that AI investments are eating into profits because companies are investing ahead into AI or the promise of AI. And that's something that's being questioned elsewhere and in India too, as some of our other programming is demonstrating. But there are signals from elsewhere too that consumption in the United States could slow down, picking up on updates from airlines, consumer companies, and even delivery companies like UPS. Cement heads for fresh consolidation. As industries go, cement is perhaps one of the biggest beneficiaries of the twin forces of massive public spending in infrastructure and private investment in construction and real estate. Add to the fact that cement is a localized industry, as in there is a limit to how far you can transport bags of cement, at least economically, and then economies of scale. Now, this is critical because cement is also a low-margin business comparatively. As manufacturing processes go, the main raw material is limestone, which is mined, crushed, and mixed with other raw materials like bauxite, clay, and iron ore. So you have to be near limestone or bauxite mines for your factory. All of this is ground into a powdered mix, and there are several more processes, including burning, before it becomes the fine powder that goes into a 50-kilogram sack and then sold. Now, this is a background, of course, to point to why consolidation is picking up pace, including in the lucrative southern markets of India. Ultratech Cement of the Aditya Birla Group has purchased a 32.7% equity stake of the promoters and their associates in India Cements. Ultratech earlier invested in India Cements to acquire about 22% at a price of about 268 per share in June 2024, and it was expected that Ultratech would move for full control. This could also help Birla meet its production target of about 183 million tons in 3 years, and its current production is about 150 million tons. The Ultratech management has said that they were approached by the promoter group, that's India Cements promoters based out of Chennai, to sell their holding in the company, and that they found it appropriate to acquire that stake. India Cements has a total capacity of about 14.5 million tons of grey cement, of which about 13 million tons is in Tamil Nadu or mostly in the south, and about 1.5 million tons is in Rajasthan. Now, here's the interesting part. While prospects for India's cement production, the second highest in the world, look good, there is a pretty big gap between capacity and production. India has an installed capacity of about 600 million tons, but production was only about 391 million tons as of last year, as per data via the Ministry of Commerce. So industry has clearly invested ahead of demand, an approach which brings its own problems, including finance, which is another reason for the consolidation that we're seeing. Adani, the other big player via acquired entities like Ambuja and ACC, controls about 77 million tons or about 15% of the market, but wants to come close to Birla's Ultratech in the near future. Ultratech wants to reach about 200 million tons of capacity, while Adani is targeting 140 million tons, according to various reports. Budget and the way forward. The Union Budget 2024 had a series of proposals for the broader economy and, of course, tax, which will keep us busy for some weeks, if not months. The larger question, of course, is the impact of these proposals going forward, even as the fine print has been and is being gone through. Now, there are some important points on how the government is seeing both income and expenditure. The former is projected lower, while the latter has been reined in. And then taxes, including on companies. I caught up with Shubadha Rao, founder of QuantEco and well-known economist, and Himanshu Parekh, partner and head of tax for West for KPMG in India. And I started off by asking Shubadha Rao why expenditure was being reined in this manner.
Thank you at the outset, Govind, for having me on the show. Yes, budget has been digested well enough, and now it's the next phase task that how is going to play out for the economy over the next 6 months till we get ready for the next budget. As you rightly said, Govind, this time the budget has been kept in leash, under control, and there are elements to it that we need to perhaps go closer and watch into. One is, of course, important part is that capex, the capital side of expenditure, which the government had been stepping up each year past 3 years, has been kept steady. While as a ratio to GDP, it still remains constant at 3.4. But there was an expectation that in the absence of private capital expenditure, will the government, instead of expectation, I would say a speculation that will the government continue to step up on its efforts to pump prime the economy via higher capital expenditure? It hasn't. It has kept it quite steady and unchanged from the interim number that had been shared by the FN at 11.11 lakh crores. The focus, therefore, was thanks to the bonanza from Reserve Bank of India through a significantly higher dividend. There was worry and fear that would that be entirely used to pump up the revenue expenditure. Also, fortunately, we find that in that there has been significant curtailment or containment within the elements of revenue expenditure. We all know interest payments are significantly higher and they constitute almost close to 50% of the total expenditure. This time round, we see there is a small dip in interest expenditure, and we believe it is doable on two counts. One is the theme of fiscal consolidation, which implies that the government borrowing is going to be lower. The second is also going to be the yield curve is expected to be softer and lower. So all put together would result in interest payment outgo to be lower in this fiscal year. The second, which we are not 100% sure about how well the government will be able to contain, though, is the subsidy outgo. Now, we were anticipating a higher outgo on food and fertilizer subsidy. That hasn't come by. Actually, subsidy has been also kept kind of steady in terms of its escalation or the widely expected. It has been contained. Our own expectation is probably the government will have to, somewhere down the line, look at an upward revision in subsidy on two counts. One, we broadly expect the LPG related subsidy likely to get extended through the year. And the reason being, we still have state elections coming forth. So perhaps that consideration would not prompt the government to withdraw that subsidy. The second being, and a more important and larger quantum of normal food subsidy, our own expectation is that the rice stocks, which are particularly, they have a cost involvement in terms of storing through the buffer norms, have been significantly higher in the food stocks in FCI.
Yeah, because of which we want to open up exports as well now.
Exactly. But how well the government will be able to do, but we will be on watch. We are not suspecting at day one. But as I said, capex has been well contained. Revenue expenditure has been well distributed. So expenditure containment has been the theme. And that is basically driving from the consideration that we need to consolidate the balance sheet of the government in a more meaningful manner at a 4.5%.
Got it. And I'm going to come back to you, Shubhada, on the income side in a moment. Himanshu, direct tax, let's talk about some of the key things that have happened. So, of course, the big news was the capital gains and the fact that it's been now restructured in a manner of speaking. There was some disappointment, some happiness, and then there were some clarifications that followed. So, where do we stand today, and how is it likely to impact tax collections in the coming, let's say, 3 to 6 months?
First and foremost, if you look at the overall theme of the budget from a tax perspective, the overall theme was to do a simplification of the onerous tax laws and facilitate ease of doing business for taxpayers. So, with that in mind, there are quite a few proposals in the budget which have to do with simplification of tax laws, reduction of tax litigation, and overall assessees in terms of facilitation of doing business. Specifically coming to the capital gains tax regime, as you rightly pointed out, that has become far too complex over the last few years, given the fact that we had a different tax treatment for different categories of assets, depending on their holding period, depending on the tax residential status of the taxpayer, whether it's a resident or a non-resident, as the case may be. And therefore, representations were made to the government to simplify that capital gains tax regime. And the government has, I think, done a marvelous job, if you were to ask me, in terms of announcing a brand new capital gains tax regime, which is very, very simple in nature. So now what has been provided for is to say that, you divide all the assets into two categories. Firstly, talking about listed securities, which will be subject to a concessional rate of tax if they are held for more than 1 year. And secondly, all other categories of assets, which will be subjected to a slightly higher rate of tax if held for more than 2 years. So, in that sense, she's done a good job of simplifying the tax regime. As you rightly pointed out, the one burning issue out here is in the context of, residential houses or residential property, which has been held by taxpayers. Until now, if you held it for 2 years and there was to be a capital gain on disposal thereof, you were subject to a 20% tax, but with an indexation benefit. Under the new regime, you will now be subject to a lower rate of 12.5% tax, but without indexation. And, withdrawing this indexation benefit could quite likely in several cases result in a higher tax burden for taxpayers. And of course, therefore, they are aggrieved by that.
Got it. Okay, so my next question really, Himanshu, is to do with the way forward. So assuming, let's say this is the new state of affairs, do you see this improving tax collections? Do you feel, there were, let's say, gaps that will get plugged?
So the entire attempt of the revenue this time, or the government this time, as I said, was to simplify the tax law and at the same time ensure that it's a tax neutral exercise. The objective was not to collect more taxes. The objective was to simplify the tax laws. And if I may say so, what are some of the other measures undertaken by the government? Like the capital gains tax regime, the TDS regime had become far too onerous. As things stand today, we have 33 TDS provisions which attract TDS ranging from 0.1% all the way up to 30%. So that regime has been simplified now. A lot of transactions which were hitherto subject to TDS at the rate of 5% have now been moved to 2% rate of tax. There are a few other simplification measures announced as far as the TDS regime is concerned. You talk about the angel tax provisions, the much controversial angel tax provisions, which were a major pain in the neck for startups. That angel tax provision has now been abolished. I think full marks to the government on that front.
That's only prospective, right? There's retrospectively, it's still hanging.
Yeah, for the past period, of course, the litigation may continue, but at least going forward, the entire tax has been abolished. And I think that's a very bold move.
So, Himanshu, if I can ask you a question there, Section 56. Now, assuming Section 56 is abolished, is that correct? That section will not exist now?
A specific aspect of Section 56,
subsection will be abolished, at least to do with income in the hands of companies. Okay. Or treated as income. I mean, this is investment which is being treated as income. Now, my question is there a chance that it will show up in some other way under some other section?
So we've had this provision, one other provision in the income tax law, known as Section 68, which also empowers the tax authorities to sort of taxpayers, especially companies which raise funds, in case they are not able to justify the source of those funds. or the genuineness of the investor. In those cases, there is already a provision existing in law. And in cases if the tax authorities believe that this is a non-genuine transaction, where the investor is non-genuine or the source of fund cannot be substantiated, there they have a possibility of sort of attacking those kind of transactions.
So you're saying Section 68 can therefore still there and can be used in similar circumstances, though not the
It's
same.
still not in all the circumstances as what we witnessed in the context of Section 56, but in select few cases where taxpayers are not able to substantiate the genuineness of the investor or the source of funds, only in those limited circumstances can the revenue invoke Section 68, not in all the cases.
In 56, the company had to pay the tax, but you're saying under 68, the investor has to pay the tax or
No,
could be hauled up?
even in Section 68, it is a company who has to pay the tax if it is not able to substantiate the genuineness of the investor. And this is in the context of the change in tax regime when it comes to buyback of shares. Until now, when a company bought back its shares, the incidence of tax was on the company buying back its shares. The company was supposed to pay 20% tax on that. They have now shifted that incidence of tax to the shareholder. And what the new provision now envisages is that whatever buyback proceeds are paid by the company to the shareholder will now be subjected to tax in the hands of the shareholder as dividend. Now, the biggest concern out here, Govind, is that take a case where a shareholder has invested in shares of a company at 100 rupees per share. The company, let's say, buys back the shares at 130 rupees per share, right? The income of the shareholder is only 30 rupees in this case, right? Because it had invested 100, it has got back 130. The way the new provision has been drafted, it is not 30 which will be taxed as dividend. It is the entire 130 which will be taxed as dividend. Although the income itself is 30, 130 will be subject to tax in the hands of shareholder as dividend. And 100, which was the cost of the shares, will now result in a capital loss for the shareholder, which he can offset against some other capital gain. So that's a new regime for buyback of shares.
So is that a good thing or no? It's not clear to me.
Not really, because now, let's say you invested 100 into a company. The company gives you back 130. So your income is 30, but you pay tax on 130. So if you are in the 30% tax bracket, you end up paying tax of 30% of 130, which is 39 rupees on an income of 30, which is weird on the face of it, right?
So I'm going to come back for one last closing in a moment. Shubhada, let's look at income now. So we've talked about the expenditure side. On the income side, the government seems to be projecting, let's say, a moderate tax revenue growth for at about 10.8%. Is that suggesting lower tax revenue or how are you seeing it?
Overall, if you look at the revenue receipts, they are going to be slightly higher at 9.6% versus what we saw at 9.2%, say, in the year gone by, the last fiscal. And if I were to look at net tax revenue, it's absolutely steady at 7.9%. And it has remained steady since FY23, it was 7.8, FY24, 7.9, and the final budget of July 23rd is also at 7.9. And that is because the share of states is going to be slightly up. So I would, in fact, say that probably the tax growth assumed is on the conservative side. And that also comes from the fact that if you look at nominal GDP, most of us on the street were broadly expecting beyond 10.5, which got announced in the interim budget. For the simple reason, even if I look at a 6.5 or 7% growth, and if you look at weighted average of consumer and wholesale price index, there would be a wholesale price index contribution which will be much larger in the current year because we expect WPI to be at 3%, which it was in contraction in the last fiscal year. So there is a small upside that we anticipate in the nominal GDP, which will also get reflected in your tax revenues, and tax buoyancy, etc. Overall, I think the components of tax and non-tax revenue probably are going to be non-tax revenue. Once again, we saw the Reserve Bank of India's last year's handsome dividend may or may not be the same magnitude, but I personally believe that there's going to be step-up function in terms of upward shift where Reserve Bank of India dividends are concerned from here on. Capital flows are going to be large. RBI will perhaps be anticipating that the Fed will cut rates. So mark-to-market gains will be there, in terms of its rupee management via curbing volatility or whatever the other reasons. Would our own estimation or our own perception is that USD-INR would be kept on a mildly depreciating path. And that would tantamount in saying that your overall RBI income is likely to stay put at a higher level. All put together, I think overall fiscal math seems to be very achievable, credible. I think in an earlier round, I said 4.6, 4.5. That is for the subsequent fiscal year. The current fiscal deficit for the current fiscal year is going to be obviously at 4.9. It makes it easier because then 50 basis point achievement in the subsequent fiscal year will look tenable, will look achievable. And when the going is good, go for the more aggressive path of fiscal consolidation, which is exactly what the government seems to have adhered to at this point.
Right. On the tax administration side, overall ease of, filing, engaging with the tax department, which is always a concern for large and small taxpayers, but more large. What's your sense? I mean, any steps taken in this budget that will start helping perhaps, or maybe not so helping so much going ahead?
The government has been undertaking several steps over the last few years on that front going. So nothing specific in this budget, but what we've seen is there has been a major tax technology drive that the government has undertaken, which facilitates filing of tax returns electronically. Now even assessment proceedings happen electronically. All correspondence with the tax authorities happen electronically. Everything happens in a faceless manner. So that's a continuous drive being undertaken by the government, and I think we are seeing the fruits thereof. And that drive will continue even going forward.
And you feel that faceless is working as well as we think it should or want it to?
And so far, I think the experience has been pretty good. Whatever results we've seen emerging from faceless assessments, in the vast majority of cases, we've seen good results coming out of that exercise. In very few cases have we seen any arbitrary orders being passed. Otherwise, in general, yes, it has been a good experience.
Shubadha and Himanshu, thank you so much for joining me. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.